Hello everyone, welcome to Smart Investing. So today's video is going to be about some banking stocks. So we have 5 stocks here for you. They're also known as banking services sector stocks. So I know I have 6 listed, but really one of these got delisted. It's actually the very first one. Sorry, let me go back to it and highlight. So this is the one. Why is it not writing? There it is. So AMRB actually got delisted, and it is now under this ticker symbol. So these are the 5 that we're going over, and we're going to start from the bottom and work our way up. So first one up is BMRC. So markets are open, but I'm not really looking at that right now. We're going to go over fundamentals, technicals, and some analysis. So first things first, we have here ticker symbol BMRC. Now, obviously, I'm looking at this first page, like I always call it. So this whole first page, looking at the numbers, I'm going to say 52-week high and low. This, I don't really like that. Volume is pretty low, but I mean, that's not always the case, depending on the stock, and see what we can do with it. Or even if it needs work, maybe it can be on a neutral list or save for later. So with the numbers that I'm seeing, it does pay a dividend. Dividend yields at 3.41. It needs work. Share price is only at $29.30. So market cap is only at $469 million. Looking at the chart for the 1 year, we have multiple bottoms here. For the year, we have a bottom here, a bottom here, and a bottom here. It's pretty much trying to break that low. And we have multiple tops here as well. We have right here, that's one. Same level, pretty much. I don't know the price for that. But again, I still see that same price range. So from here to here. So it's only like a $5 price range. It's not much. So looking at the technicals, we can dig a little bit deeper. So it looks like it's breaking the low barely. But even if it's a slight push going under, we still want to see that for a few more weeks and keep it there under for a few weeks. Then for sure that will give me confirmation that it's going to stay there. Whether even if it pops back up, it might be a fake or not, but most likely bank stocks don't come in heavy when it comes to volume. So I'm a betting man, and I'll say that this stock is gonna go to newer lows. And now moving on to some fundamentals. Some quants and then some fundamentals. So we had the basic info. We went over some technicals. Quick analysis. So the highest rating that we have is growth. So for growth, I would have to look at the numbers for some fundamentals, see if this is an actual growth company. Other than that, overall rating is rated 4 out of 5 for a bank. It's hard to see that when you're not looking at fundamentals, but we can always see. So it looks like their earnings have been beating their earnings and rising. So we see here Q1 2023. lowered so much for the estimate. So we went from around, let's say around 80 cents. I don't know. Let's just guesstimate. And then the expected is around, I don't know, 68 about. So doesn't seem like much, but when a company is so small, those pennies matter for earnings. So, I mean, just looking, even if I had no numbers here, just looking at this drop, that's a pretty big drop. So we're looking back at around close to the Q2 earnings when we're like at around here. So I think that's a pretty big drop. So moving on to their annual, hopefully we have some 2022 numbers, and we do. Looking at it, comparing to the past 5 years, it's on par for what it's been doing for the past 5 years. You know, nothing crazy. You know, it's at 1.1%. The highest was at 1.31, and that was 2018 and 19. So it's actually not too far. It's not drastic. Nothing crazy. So we have 2022 for return on equity. We have about 11%. Earnings slightly up at 2.9 comparing to 2.3 before. So that's pretty good. Now, I want to see some margins here. It's not showing me any margins. Typically, that's high on debt, 90%. Net income, 46 million. So, again, 40% more than last year. So, they went from 46.6 million up from 33.2 million. So, it's actually pretty good. So, we have here a balance sheet, pretty typical for a bank. I'm going to skip that and just look at their cash flow. So operating is at 45, 340. So they need at least 300 million for their financing. So the cash flow positive, which ain't bad. And it looks like they can afford their dividends. So we want to look at the dividends real quick. And then raising their dividends by 1 cent. So anyhow, the splits were 3 splits, 99, 2004, and 2018. Last split was in 2018, 2-for-1. So we have here, it just needs work. I want to see the market cap go higher than this. But they're on target, actually doing good with their earnings. And then these earning estimates are going to be crazy. So even though earnings estimates are going lower, that's really the trick. Even if they beat estimates, we're going to see how far and how high these numbers jump up. Not only for the earnings, their price, and also their fundamentals as well. Because obviously, the price, it looks like it's pretty much heading towards undervalued territory. But again, the market cap needs to grow some more. So I'm going to say needs more work. So it's not a yes or no. I'm just leaving it blank, leaving it neutral. So don't even put this as a watch list. I guess hopefully in a few years it'll be a better company, bigger. I really don't see any momentum in this stock. I mean, sure, it has some growth, but to rate it that high, I wouldn't rate it that high. I see some growth, but because of the earnings. And again, I don't have the numbers for the revenue, so I apologize for that. So obviously this bank acquired AMRB. So again, that's the reason why. So other than that, that's why it has some growth to it. But I wouldn't add it to the watch list. So next one up is DFS, Discover Financial Services. A very popular stock. I'm sure many people have heard of this company. Uh, I don't think they're a bank. I think they do consumer lending, but I guess I'm wrong. So they are a bank, but for some reason they are a mid-cap company. So we have here at $29.29 billion company. So this company is pretty strong in terms of market cap. So looking at the first page, these numbers actually look pretty solid comparing to a lot of other banks. 52-week high and low. Oh, sorry, I covered the one here on the 52-week high. So 52-week high and low, that's a nice price range for the year. So we're looking at least around $50 or close to it. Well, at least 40 to be more accurate, at least $40. So that's pretty good. And then earnings are at 15, a whopping 15.5. PE ratio is telling me that it's very undervalued. Dividend is at 2.4, which ain't bad. I've seen better companies that are similar companies paying that dividend, or similar industries. Dividend yield is pretty low at 2.15. I know you guys, some people like higher dividend yield, so sorry for that. It's not a high yielding stock, but still pretty solid numbers based on capital. So looking at the numbers, we have here the stock price is at 111.61 cents as of right now. So we have here these price ranges from around 118 high, so multiple tops and pretty much multiple bottoms at a low of around $90. So it's actually holding up for the year. You see these big spikes, so I want to get confirmation and see what breaks out, but that may take too long to determine where it might actually go. So we're just going to go on to the next analysis for this. Looking at the quants, highest rating that we have is quality at 7.25. Overall rating that it has, again, this is not final, but just a suggestion. Rated strong, so rated 4 out of a 5. Now, for the company, we want to see some fundamentals and see what's going on. So, again, like I said, very strong earnings. And then we have here Q1 for 2022, really big beat, small beat. And then it missed slightly in Q3, Q4, beat estimates. Then in Q1, upgraded their estimates, but not by much. So we went from around 373 to, well, actually it is, now that I look at the numbers. So close to what, $4? So a 25-cent. Yeah, like a 25-cent earning estimate that was raised. So looking at the numbers fundamentally, if it allows me to pull it up, it's not. Let me close it again and open it again. So looking at DFS, sometimes just a little bit lag, but I'm getting full service here and full connection, so I don't know why it's not coming up. So again, let's see here. ROA. Here we go. So ROA, I guess it's on par. I got lower from 2021, so it went down to 3%. So from pretty much 5% went to 3.6. So we're looking at a loss of 1.5%, give or take. And then return on equity dropped down a little bit. You can see here in this chart, 44% compared to 31, so at least 10%. So that's a pretty big chunk. Right away, what stood out to me, this little bar and this big bar, it's just insane. So they went from earnings of close to 18, dropping down to like 15. But the real big mover is this one, going from around 3.6 all the way to close to 18. So we're like close to 4 times earnings. That's insane. So you can tell how much money that was pumped into the market for this company to grow 4 times in 1 year. So obviously that wasn't because of the company doing better. That was because of a lot of money being put into the system from the Fed going into the stock market and buying these stocks. So debt, 88%. So inflated value. We have income from about $5 billion last year. I keep saying last year because we're just in 2023. But comparing 2021 to 2022, down to 4.39. So that's a loss of like at least close to $1 billion. That's a pretty big chunk, if you ask me. Now, cash flow we have here is at 7.14. So we have 25. I'm doing the math in my head. Hold on. So that's about 18. So they have to have over 18 or close to 18. So cash flow is negative, down 2 billion. Now, what do they have for net? They better have over 2 billion. See, if the market didn't come into play, because right here it was actually before 2020, if it was normal, they just would have had enough cash flow. So half of that money already is pretty much covering the cash flow, and whatever's left over, which would be 2 billion, pretty much saved this company. So what I'm saying is, looking at the numbers, they would have been operating on negative cash flow and even higher debt if this wasn't the case in 2020. And this is definitely a company that would have been bankrupt. I'd definitely be careful of this company. I mean, it seems fine, but when you dig into that cash flow, definitely something not to take lightly. And we have here, again, like I said, they're $1 billion company, so close to, excuse me, close to a $30 billion company. They have nice dividend raises. So we have here 44 cents going to 50 cents. So these are nice raises. But again, these are unsustainable, really, ever since 2020. So again, this stock, I would say no. Next stock up that we have is MCBC. So MCBC, we have here 5-year chart. So market cap is at 372 million. 52-week high and low, awful range. Volume is low, but that doesn't matter. Market cap is really low. Earnings, it's only at 1. Awful numbers. Awful numbers. What else we have here? So for 5-year, we have a low of about 6 and change, a high of about, I don't know, being generous, give it to 11. So 7, 8, 9, 10, 11. Only a $5 range within the last 5 years. Awful amount of capital being put into this if you invested in this, and then not much capital that you have returned to you. So crappy stock, I'm gonna say no already right off the bat. Quality, even though it might have quality, and the overall rating that was suggested, 7.21. So with that, we have here beating their estimates in first quarter, second quarter, third quarter, and fourth. Then we have here estimates are about the same for Q1. And then we have here annual numbers. So they look about the same. 91%, close to 92% for their debt. Now we just want to look at their cash flow. Net income's at 34 million. Operating is at 34.8. $42 million negative cash flow. Operating 34. So definite no. Too much negative cash flow. Awful. So right away, just gonna move on to the next one. So far none of these stocks are even good. So we only have about 2 more. SNTG is the next one. So we have it. Market cap is at 5.91.
Yeah, but you know what? 1 or 2 days alone with us, he might change his mind and want to hang out with Louis. I love you.
So looking at these numbers, 52-week high, 52-week low, difference of about 8. Negative earnings. Sorry, I couldn't circle it. PE is not even showing me. But just with the negative earnings alone, that says a lot. They're not paying a dividend, which I understand. We have here 5-year. So we went from $185 all the way to, wow, down there. This is not typical for a bank stock. So something must have, there we go. Something must have happened. That's what it was. So we have here, yeah, I was thinking that's not typical for a bank. So they are consumer lending, SNTG. And then again, with this chart, it's still awful anyway, not gaining much. So awful companies. We have here analysis, quant ratings, nothing suggested. So I have 2 out of the 3. Most of the fundamentals, and then the chart looks pretty bad. I have here ROA from 2021, negative 10%, then ROE. It's not showing me numbers. I'm gonna try to open this again, so I apologize for that. So SNTG, we have here ROE, and then it's only giving me 2021 numbers. I don't like the numbers anyway, so even when they do come out with 2022 estimates, I wouldn't be too fond of it anyway. Revenue has gone down. Net income went down in 2021. Balance sheet looked awesome in 2021. I mean, look at that. Only 3% in debt for 2021. And then their assets were 17 million. So, I mean, amazing numbers for the balance sheet in 2021. But nobody seems interested in this stock anyway. And then negative earnings. So, right away, I would stay away from this stock. So, not even worth it. Not even for income, anything, growth, nothing. So, no to that one as well. And the last one, so far, none of these stocks added to watch list. Last one is UMPQ. So for UMPQ, looking at the chart, okay, respectable. They have a market cap of about 4 billion. Volume is higher than most banks and higher than normal. 52-week high and low, a difference of about 7. That kind of sucks. Dividend sucks. PE, it's, I wouldn't say normal. It's almost starting to go to undervalued territory. It's borderline between normal value and going to undervalued territory. Let's look at the 5-year. So it's actually holding up just from the 2020 highs, which is actually pretty good. You see these whipsaws here, so volatile stock. But again, volatility can present opportunity. So within these ranges for the year, we have a low of about 15, a high of about 20. So we have those $5 ranges. And then looking at that, moving on to the analysis part, we have here quant rating of 5.65, highest rating for the income. Overall rating was 2 out of 5. Want to look into some fundamentals and see what's going on with that. Income, well, we'll see if it provides with the numbers, if it looks okay. Now for the earnings, Q1 it beat, miss, a miss, and a miss. And it's crazy how these misses, like these estimates, they just keep getting wider and wider and even more. And they're just pretty much flat. What was their earnings? So a 1.5. And I'm assuming that was for last year. So who knows? So ROA dropped down in 2022 slightly. Return on equity slightly dropped down. Earnings dropped down slightly. So not by much. It's just the estimates that Wall Street gave that's making it harder on them. But again, these numbers are still flat, even with the last 5 years here. We have here no money put into this company. So we have pretty much flat income for the last 5 years. Revenue is not showing me anything. Typical debt. Then we have the cash flow, which is the meat on the bones here. So this is like one of the most important factor, if not probably the number one factor in all of this when it comes to banking. So we have here positive cash flow, okay, with a difference of about, I'd say around 160 at least. So they have positive cash flow, but again, those earnings are what's killing them for the last 4 quarters. Not only, see, the thing is, even if they missed all of them, as long as if they didn't miss by much. But starting from Q3, that's when the trouble began. You can see it's not by much, but in Q4, that was it. And then in Q1 for 2023, that's like the nail in the coffin. So with these two alone, that's going to make it extremely difficult for this stock to even beat it. So I'm sure this company is going to have less of a market cap by the end of the year. Prices are going to drop on this one. Not a good stock. Let's look at the dividend real quick, even though I think it's a bad stock. Flat numbers here. Dividend payments of 21 cents for like the past 5 years. And then everything else below that was only like 1 or 2 cents. So you have here in 2018, 20 cents. In 2017, 18 cents. So not much of a raise. Better than nothing, but not much of a raise. So for this stock, say no as well. So none of these companies are good. Thank you guys for watching. I'm going to evaluate more companies. I've been busy, so I know I try to do one every other day. I can't. I just do it when I can. So again, thank you guys for your patience. Thank you guys for watching, whether you see my long videos or short videos. Again, I have way more content to reveal for you guys. So see you guys next time and enjoy your day.